Rory, thank you very much for joining us today. One of the things I try to do on this podcast is speak to experts like yourself on topics which influence both the economy and also financial markets. And today we're going to do a deep dive on oil. And for those who aren't familiar with you or your firm, Commodity Context, why don't you tell us a little bit about your firm?
Yeah, thanks for having me on, James. So Commodity Context is my independent oil market research product. It's hosted on Substack. And I have three main types of research. I publish my weekly, which is Oil Context Weekly, every Friday at close of business after the Commitments for Traders report comes out, so that you get nice, fresh views on kind of latest positioning in the market. I have three different monthly reports on global oil balances, North American oil detail, and OPEC policy and production. And then finally, I have thematic research that I kind of typically do 2 to 3 of those a month on kind of various topics. The last one, as I was just saying before we started filming, was on everything happening in Venezuela. And until what's been happening right now and Iran broke out, I was traveling in Calgary and Ottawa talking all about what Venezuela meant for the Canadian oil patch. So it's been a crazy first quarter, definitely busiest first quarter of my career to date. So let's talk about it.
Well, I cannot think of another commodity which has a larger impact on the economy than the price of oil. It's used in every facet of our lives, not just gas for cars, but also diesel for tractor trailers and trains and jet fuel for planes. 15% of all oil is used to produce petrochemicals such as plastics, synthetic fibers, detergents, and even pharmaceuticals. And it's one of the largest markets in the world when it comes to trading. The physical market is about $8 billion daily. When you look at the futures market and the derivatives market, it's over $200 billion, so quite huge. And we've seen some crazy volatility here year to date in the price of oil. And it started the year at $60 a barrel. I can't believe it was that low. But anyways, that's where it started the year. And now it's significantly higher. I'm not even going to throw it a price because it changes every 5 minutes. But one of the reasons why we've seen so much volatility is because of what's happening in the Middle East and the Strait of Hormuz. And on February the 27th, there was 141 ships that had passed through the strait. And then on February the 28th, when the war broke out, it's virtually zero. So maybe we can just start right here and tell us about the Strait of Hormuz and why it is so important to the transportation of oil.
Yeah, so the Strait of Hormuz is often referred to as the world's most important maritime choke point. And I think this is showing why that is the case. Just for perspective, what we're talking about, the flow through the Strait of Hormuz is roughly 20 million barrels a day in normal times. Rounding, that's roughly a fifth of total global oil supplies. That is a truly stupendous volume of oil, and it's the only way that the vast majority of oil produced in the Middle East by countries around the Gulf, Iraq, Kuwait, Saudi Arabia, the Emirates, Iran itself, really it all comes through the Strait. So when that's disrupted, and this has kind of been the ultimate risk scenario, the ultimate boogeyman that was kind of taught to every oil analyst when they were kind of born into this industry was, by the way, there's this thing called the Strait of Hormuz. Iran threatens it a lot. If it ever closed, the entire global economy would melt down. And we're like, oh, okay, that's a fun, nasty bedtime story to kind of almost as a thought experiment to get analysts to figure out, okay, how would this break and what would happen? Honestly, James, I never thought I would actually see it closed in my lifetime. It's just too big a thing. And it's not that I didn't think Iran could do it. Obviously, they can. I didn't think a U.S. administration, like we're seeing with President Donald Trump, would push the Iranians to this stage. Because frankly, this is now coming down to a battle of attrition, a battle of patience. And the Iranians have been preparing for this for decades. This validates the entire regime's ideology of resistance and kind of hunkering down. So even if, they'll lose layers and layers of leadership, which they already have, they're very happy and content to continue pounding and restricting traffic through the strait until the global economy buckles and the U.S. president is forced to retreat. But just again, to put that number in perspective, 20 million barrels a day. That is it's hard to overstate. That is the rough volume of demand that we lost during the peak of COVID era demand destruction in March and April of 2020, when every plane was grounded, when you and I were locked inside. I was at this stage basically still wiping down my Amazon delivery boxes with Lysol wipes because we had no idea what was going on. That was the kind of environment that a 20% reduction in global petroleum demand looks like. But now, if the strait remains closed, which again, a lot of this conversation, we'll talk about all the ways there could be leakage and whether or not it will remain closed and everything else. But if it remains closed, let's just work on that kind of dire scenario just to kind of game out what that would look like. You would need to roughly destroy 20 million barrels of demand to balance the market. And you need to basically replicate COVID-era mobility conditions without a pandemic and without global lockdowns, just through price incentive alone. So the question is, at what price of fuel, James, would you lock back down like in 2020? The number is astronomically high.
Well, very good points. So now I'm very surprised. We've seen hostilities in the Middle East going on for many decades, and you've implied that you never saw this happen before. So is that a fact? Like the Strait of Hormuz has never been shut down before?
Correct. It's never been shut. And we've actually had more violence in the Strait in the past. For instance, for those that may be aware of something called the tanker wars, which is kind of where all of this fear initially kind of began after the Iranian Revolution and during the Iran-Iraq War in the 1980s. You basically started launching, both sides started launching missiles into the Gulf in order to destroy the other shipping activity. And during that period between roughly, the tanker wars were throughout the entire 80s, but the most intense period was kind of through the late 80s, kind of 84 to 88. During that period, you had roughly 450 ships that were attacked. You had 250 of them were tankers. And of those 250, you actually had like a 20% kill rate, basically, that, 55 tankers, roughly in the estimates I've seen historically, were either sunk outright or scuttled and abandoned by crews. That isn't where we're at yet, but that could be very quickly where we're going. But during that period, we never stopped flowing tankers through the strait. Now, at that stage, particularly coming out of the 1970s oil crises and the oil shocks, I think global economies were especially vulnerable and even more sensitive to oil prices back then than they are now. Oil demand in Western countries has largely kind of, dipped down, basically plateaued to lower since that period. Whereas our economies have gotten much bigger. So as a proportion of our spending, oil is far less important today than it was back then. But I think particularly for consumer sentiment, for inflationary expectations, it still remains as consequential as it was back then, because you ask your average person at the supermarket, what's the price of wholesale wheat or what's the price of wholesale copper? No one can tell you. But ask what the price of gas is, and they're going to be acutely aware because they've driven past a dozen signs on the way down the road, which is why back in 2022, when during the crisis of the inflationary spike and following Russia's invasion of Ukraine, the Federal Reserve in particular under Jerome Powell was very, very sensitive to oil prices and the risk that they were going to unmoor inflation expectations. So, while the Fed, as you well know, typically looks through, energy and food prices, these volatile components of price movement, to kind of get a gauge of an underlying inflationary trend, the worry in 2022 and during that spike was that you could untether the inflation expectations, and then you really end up back in the 1970s. Then you kind of need a Volcker-esque shock in order to reset and re-anchor those expectations. Thankfully, they never ended up flying away because we didn't lose nearly as much oil as we thought we were going to out of Russia. We thought we were going to lose 3 million barrels. We only lost 1 million for a month or two, and that was right back to normal. We had the SPR release, and eventually we basically had COVID zero policies in China that locked down China and basically saved the world from a price spike. So we avoided that then. But right now, there's no pandemic, there's no COVID zero, and this is not a 3 million barrel a day fear of loss. This is a 15 to 20 million barrel a day realized loss. We're already in it. Already in the Middle East, we've already confirmed that there's more production shut in, not just even throttled through the Strait. There's more production shut in countries throughout the Persian and Arab Gulf, than more than double the volume that we feared closing in Russia. So this is it breaks every historical parallel. It sounds alarmist, and I really try to say, I am not an alarmist. I am just really, really alarmed. And this is the kind of scenario that I just never thought we'd see speed run in real time.
You're just stating the facts. So I want to talk about this backlog because I've read many estimates on how many tankers and LNG carriers and also cargo ships that are waiting to get through the strait. I saw one report that said over 200. Another one said the number's over 500. Do you have any insights on how many ships are waiting to get through?
I think those sound. I think those might be roughly the same estimate. That it might be roughly like 250 on each side, so like 500 total. And I think what we're looking at here is essentially we have big backlogs on both sides. We have the tankers trying to get out, filled with crude and products, and those are the ones that, frankly, for the record, even the ones that aren't trying to transit the strait. Yesterday, we saw that the Iranians used 2 naval drones to blow up 2 tankers that were parked off the coast of Iraq, well away from the strait. So Iran is starting to take pot shots of even stable, static and kind of unmoving tankers. So there might actually be almost like right now, there's a fear of going through the strait because you don't want to get shot. But if you start shooting them on that side, they might all try and bail at once anyways to get away from the fire. So we'll see how that goes. But there's also a similar amount on the other side, unladen, empty, waiting to enter. And because of this big pileup, again, there's a lot of parallels to COVID because, again, that's our most recent reference point for acute kind of debilitating supply chain bottlenecks and kind of these things that take time to unwind. Those 250 ships on either side are all going to be clamoring to get to the same places to unload and load. So then there's going to be lines. Then there's going to be all of these queues on the other side. So even if tanker traffic resumed today, it would take weeks for tanker traffic and tanker movements to normalize and likely months for broader markets to normalize because we've already had, again, we're in day 13 of this so far. That's roughly at give or take 15, 20 million barrels a day coming out of the strait. That's an air pocket that's emerged out of the exports, basically a gap in the normal flow of crude that's largely going to Asia. That gap is roughly 250 million barrels sized now. That is a lot of air pocket. And I think while we see right now, and as you've noted, the price has been all over the place. We're taping this, it was Thursday morning on the 12th of March. We're sitting right below $100 a barrel on Brent right now, which, by the way, I think is, I'll never say this, but this is firmly too low. The price should be far higher given what we've already seen, let alone the risk we still face. But as that continues, I think that's where we're going to head.
So that's my next question, because I was going to say, let's look at a worst case scenario. Let's say the strait is shut down for another 2 weeks. Where does the oil price go?
And I would say that's honestly at this stage, that's almost the base case. That's not even the worst case because it doesn't seem like this is going to wrap. We're going to talk all about the edges of this, of why that is. But if we're closed for another 2 weeks, then that basically goes from a half a billion barrel air gap to a billion barrel air gap. And while I think sentiment and kind of this handicapping of will he, won't he, is he tacoing, is he not? What's happening in this, in the U.S. willingness to continue this morning. I mean, just literally as we were getting on getting on to film this podcast, President Trump basically said, we need to do what we need to do in Iran. The oil, it's much more important than any impact to the oil price. That doesn't sound like he's ready to wrap this up. So in 2 weeks, that $500 million, or say $250 million becomes $500 million. And that roughly in 2 weeks, 2 weeks ago, roughly, we still had laden tankers leaving the Gulf. Those tankers probably take a month and a half to get where they're going in Asia. So the physical pain hasn't started yet. It's coming, and everyone knows it's coming, but it hasn't hit shore. That $250 billion barrel air gap that could become $500 million in 2 weeks. I should say billion, not trillion. That was a Freudian slip in the context. But if this continues, that air gap is going to hit land in Asia. When that happens, that is when you're going to begin drawing 10 plus million barrels a day of crude from regional stocks. There's no way that you can begin to kind of massage the narrative. You can't jawbone that kind of physical loss. The physical premiums will bid up well past paper markets and will drag the entire market with it.
Every $10 move in the price of oil is approximately 25 cents at the pumps in the U.S. And according to the CAA, the average price across the U.S. right now is $3.50 a gallon. That's up from $2.80 in January. And of course, that depends on what region and state you're into. And in the state of California, it's well over $5 a gallon. But it's just not the price of gas. It's also the price of diesel, which is used by truckers, farmers, railroads. Can you just speak to what's happening with the price of diesel?
Yeah, and I think so what we've seen coming out, even going into this, and I think what we saw this most acutely start around 2020 with the 2022, when the refining crises and kind of everything kind of COVID, ever since that crisis, middle distillates markets, by which we mean diesel, gas oil, and jet fuel, they're all very similar molecules in the kind of refining process. they have been the tightest part of the global refined product market ever since. Just because we've actually had relatively, like historically, it's always been gasoline has been kind of the point that everyone's focused on. But gasoline markets are generally pretty well supplied. It's that middle distillate that's been undersupplied. So what we saw back then was you hit 80. Normally crack spreads or refining margins are about $20 a barrel for diesel. In 2022, they hit $80 or more. Coming into this crisis, we were already tight in that market. We were already about $40 crack spreads in anticipation of this. And that spiked by 50% after it actually started. So we're at $50, $60 a barrel crack spreads for diesel. So that means even if you're seeing $100 a barrel on crude, you're paying the effective equivalent of $150, $160 a barrel already for diesel. And this crisis is only getting started. Your crude's going to continue ratcheting up, and those middle distillates are going to continue ratcheting up. And that whole refining complex is getting tighter even faster than the crude oil market. I mentioned that kind of air pocket that emerged in that trade to Asia. Because of that, though, if you're an Asian refiner, your worst case scenario is shutting down and actually getting to turn everything off, because these are massive flowing kind of polymer and chemistry sets. You don't want to turn these things off. It's very, very onerous to do so. And it's a lot of work to get them started back up after it happens. So for them, they are trying to extend the runway that they can remain operating at all, with the loss of this crude feedstock. So let's say they were operating at 90% capacity before. They're down to 65% capacity now. So they've already throttled considerably. So that air pocket, while it's moving and it's taking a while to get to Asia for crude, the products have front run that. So that's why you've already seen jet fuel in Asia last week spiked over $200 a barrel equivalent. This is the kind of situation, and that's what's going to make this process even harder. So the demand destruction we talk about, all these things that the market's going to have to reckon with if this continues. And again, it can't continue, yet it seems to be continuing. If that continues, it's going to be the product prices, not the crude price. It's actually going to drive that demand destruction. So you mentioned, if you drive a diesel Hemi, or if you've got a diesel vehicle, it's going to be especially painful for you. I joked back in 2020, late 2021, I traded a diesel BMW kind of station wagon for a gasoline SUV, and I was like, it's the best physical trade I've ever made in the market. And I still believe that, because anyone that has personal diesel exposure right now is going to feel this exceptionally more painfully. And obviously, diesel is the industrial fuel, the kind of the fuel that powers the locomotion of industry. So even if you have a gasoline car, the truck that gets your produce to the grocery market, that's on diesel. Everything else runs on diesel, and that's going to be the thing. Gasoline has the most acute kind of consumer pressure and inflation expectations effect, but the actual structural impact to inflation more structurally is on the diesel side of the equation.
You mentioned that jet fuel was $200 a barrel in Asia. That's up from how much?
That would have been, prior to that would have been like less than 100. You had jet fuel prices in Asia more than double. If we were talking about, let's say, $30, $40 crack spreads before this with $60 crude, yeah, you're staying at $100. Now both sides of that have exploded, and we're kind of over 200. It's come back down now, and I think part of this is that there was this immediate, massive kind of scramble coming out of this past weekend. So part of the issue with jet fuel specifically, and why each of these products is going to be different, is the consumption and the stock holdings is different than you'd see in diesel or gasoline, or crude for that matter. In jet fuel, you typically have smaller overall inventories, which means you have less cover should there be a disruption. And a lot of these airlines won't have entirely hedged their demand or their consumption of this fuel. And given that if they can't get fuel, they're going to ground their own planes. They all scrape. So basically you had refiners pulling back, not enough stocks on a margin, and all of the consumer base clamoring to try and get into secure supplies in the spot market immediately. That's what pushed it up. I think that has eased a little bit, but I think we're going to kind of move in this kind of jerky stepwise pattern where every week we go through this, we're going to pop higher, drift lower, but it's going to be high. That drift lower is going to be higher than the last step. And I think this is going to be a pattern that repeats every time we have a weekend where this doesn't end. Because again, what we've seen time and time again with the Trump administration is they do big, cinematic, flashy things, and then they wrap it really quickly. We saw this with the attack on Soleimani when the U.S. killed IRGC Commander Soleimani in the beginning of 2020. Big thing, and then kind of quickly back to the drawing board or back to the negotiating table. Then you had Venezuela, when Nicolas Maduro was kidnapped on a Saturday, and by Monday they were like, we've got Delcy Rodriguez in the government. She's the president. She's our person now, and it's fine. And then even last June, during the 12-day war between Israel and Iran, the U.S. actually did its first big, massive, flashy thing with Iran when it dropped 14 bunker busters on 3 nuclear sites between Fordow, Isfahan, and Natanz. That was a massive escalation at the time, and prices spiked immediately on Monday when they opened. And by the end of the day, Trump basically was like, and we have a ceasefire, and prices ended down by $10 by the end of that day. That was my mental model going into this, because Trump had shown he's entirely fine breaking every kind of normal kind of, standard of behavior and how the president would normally act in these types of situations. But he has shown consistently a lack of appetite for prolonged, distracting, kind of messy activities that kind of bind his own mobility. He likes to do big things, smack, and then move on to something else. I thought he was going to smack Iran, maybe kill a bunch of the leadership like we saw in the opening salvo when he killed the supreme commander. And then I thought he was going to say, victory's ours, go back, and now we're gonna roll over on Cuba now. That was my expectation. And it just seems that I think the White House also expected that. They expected some kind of Iranian Delcy Rodriguez character to emerge, and they grievously misjudged the cultural differences between the ruling kind of Chavista parties in Venezuela and the kind of Islamic Republic of Iran of decades and decades of resistance politics and entrenchment, basically building for this exact moment. So I think the White House did not plan for this to kind of be such a quagmire, and they clearly have no plan on how to manage the oil impacts now that they're in, and they don't really have a plan on how to get out.
So I always like to look at things from an economic point of view or from a consumer point of view, and it sounds to me like it's just a matter of time before the consumer starts getting hit with a lot of fuel surcharges from airlines, from Amazon, anybody else. What are your thoughts on that?
100%. So we're going to see this in the pump price. We're going to see this in surcharges. If you can lock in a flight right now, probably a good time to do so. These types of things, this will continue happening. But one thing I've been really stressing, just in terms of when we think about, because again, if the strait remains closed and we need to lose 20 million barrels a day, where is it going to come from? It's likely not going to come from advanced economies. We're going to experience this as kind of acute, debilitating, pump price spikes that will sap consumer spending power, that will be, the point of single complaint of every consumer on the street. But fundamentally, we're going to pay it. I am extremely price insensitive when it comes to getting my kids to school in the morning. It doesn't matter if the price at the pump was $5 a liter. I'm paying it to get the kids to school. Much of the world doesn't have that luxury. And if you're in a poorer country in the global south, developing economies and emerging markets, even if there are individuals in those economies that can afford those prices and aren't sensitive, the overall average or kind of marginal consumer is very, very price sensitive at these levels. So they will not be able to afford those prices at the pump. And because of that, they will not be able to incentivize and attract the necessary imports into their economies in order to make that balancing work. So we will feel acute pump price pain. We will feel kind of that loss of spending power, but we will still fundamentally have fuel very likely. There will likely be mixed shortages in different products and whatever, but fundamentally we'll get the product we need because we can pay for it. In emerging markets, it's going to manifest as outright physical shortages, which for many economies are going to be like literally a human catastrophe and a deadly proposition. I think the one telling and kind of infamous example from 2022 when the crisis occurred in 2022 was the status of an LNG tanker that was contracted for delivery to Pakistan. And basically, the spot prices in Europe skyrocketed to such insane levels that the contractor, the shipper, was basically able to break that fixed contract with Pakistan, pay the fee, and still make off like with a king's ransom, arbing that difference and shipping that Pakistani kind of destined LNG cargo to Europe. So again, that's the way this market's going to work. That's how this is going to clear in a capitalist kind of open traded system. But that means that for that month, you had planned to receive an LNG tanker into Pakistan for power generation or fuel or whatever, heating, and you didn't get it. So again, they can't get to the prices that will be debilitating because they're already debilitated and they're going to have the physical shortages. And I think that's what we're going to see across a whole slew of product markets.
Let's talk about the SPR now. The International Energy Agency, or the IEA, has 32 member nations. It holds 1.8 billion barrels of oil in reserves. They just announced the release of 400 million barrels, which is the single largest release ever. Is this significant? Is it going to have any impact on the price of oil?
It's definitely significant. I think it's, to put in context, this is 400 million barrels. It's twice the size of the second largest release in history, which was roughly about 180 million barrels, give or take, and that was in 2022 during the Russia price spike. This is substantial. What we've seen, while the details are still a little spotty as to exactly what to expect and when to expect it, Energy Secretary Chris Wright in the United States has stated that their 172 million barrel release is going to happen over roughly 120 days, which works out to roughly a flow rate of 1.4 million barrels a day. And for context, that's the important part, is the flow rate, not the overall volume, because the flow rate is essentially what manifests in the market as supply. So if we take that and expand that flow rate to the entire kind of release, we're probably talking about somewhere in the ballpark of 3-ish million barrels a day of supply. That's a lot of supply. We've never seen a strategic release of that size. But again, as the IEA executive director put it, this is an unprecedented supply crisis, and it warranted an unprecedentedly large SPR release. So it helps. It's the only thing that the Western nations can really do in this moment. And I think important, and what's shocking to me is that we're 2 weeks into this, and this is only decided yesterday. Back to the point that the Trump administration did not have a plan going into Iran for a prolonged period of time. If they did, any first-year intern at the National Economic Council and National Security Council, they're like, we're planning on bombing the crap out of Iran. Anything you could think on the risks. Like, well, probably oil in the Strait of Hormuz. Oh, interesting. Well, we should probably plan for that. Clearly, that's like the number one easiest low-hanging fruit to any kind of risk management here, and they didn't do any of it. You hadn't seen a pre-planning on the SPR. You hadn't seen kind of liaising with the IEA or the IEA allied kind of member countries. You hadn't. There's so many things that this last-minute insurance or reinsurance facility that Treasury launched. All this stuff. They're on their back foot. They're doing this on the fly. And that's not how good effective policymaking is made, and we're seeing the consequences of that right now. So overall, I would say it's a great step in the right direction. It's a Band-Aid, and it's a small Band-Aid of that 3 million barrels a day versus 15 to 20 million barrels lost a day in Hormuz. But it's the right thing to do, and we should have done it a week or two ago, not right now.
Earlier, you touched on the 1970s, and I just want to go through this and provide a little more context for the viewers. But in October of 1973, we had the Yom Kippur War that led to the Arab oil embargo, where the price of oil went from $3 a barrel to over $12 a barrel in a matter of months, and also inflation exploded. And then in 1979, we had another price shock with the Iranian Revolution, and the price of oil went from $14 a barrel to $38 a barrel. And over that 10-year period, the price of oil went from $3 at its lowest to $38. And during the same time, the inflation price went from 3% to 13.5%. Do you see this same sort of scenario unfolding? Like if things progressively get worse here?
I think in rough strokes, yes. I think the magnitude of those kind of proportional gains probably won't be seen, because going into that, the oil market wasn't the same oil market that we experience now. It wasn't a freely traded kind of commodity market. It was largely an internally kind of secured supply chain market, and the price was largely a tax balancing factor for companies like Exxon and Chevron, what were called at the time the Seven Sisters, the 7 major integrated oil companies. They essentially produced oil in the Persian Gulf or wherever else, and they basically traded it to their own refineries, and that price was largely a balancing factor for their own books, and the price used to pay the producing countries, like Saudi Arabia as an example, for royalties for their production. So they actually had an incentive to keep that price kind of artificially low, and they did. So they charged far higher prices for products than you would have assumed, all else equal, than the price of crude going in. So all of this happened, and part of what happened during both the formation of OPEC in the late 60s, and then the Arab OPEC oil embargo in 73, and then Iran in 79, forward. This was all kind of that system beginning to unravel in rapid fashion. And the other thing I should note here is that while the current crisis in many ways is already worse than the 70s, that in the 70s, a large part of it was that, the Arab OPEC nations said, we're going to have an embargo on shipping oil to basically the United States and the UK and anyone associated with Israel. Similar in some ways to now with Iran, but that was kind of it was more about a certain directional blockage rather than overall physical laws. And what we've seen actually over the past, let's say 5 years, is that when you have those types of physical dislocations, but the barrels are still in the market somewhere, the market's really, really good at solving and kind of arbing those volumes and those barrels to where they need to go. What we're seeing in the current situation is not a directional kind of strategic withholding. It's a complete deadweight loss in the market. And that's much harder to kind of balance. We do have lots of stocks. We do have strategic stocks. We have lots of things that we can do around the margins. But I think this is going to basically take every ounce of flex the oil market has. And the risk is that you do that too much and it just snaps. And then it's going to take a long time to kind of rebuild and unwind everything in the middle, which is why, again, I can't believe we're already 2 weeks into this, James. I never in my life would I have expected us to come this far. And now it just feels like, how do we get out? How does Trump declare victory without looking like he lost? I don't think Trump at this stage is going to want to look like Carter, right? This is his risk. A deeply unpopular war in the Middle East that you lose really quickly. There can be no greater kind of harm foul for a U.S. president, particularly if it came alongside massive pump prices and spikes at the pump. And I think that's the calculus Trump's trying to make, is how far can I go? How quickly can I get to any stage where I can declare even a modicum of TV victory speech? And how long is it going to take? Because people are talking about CENTCOM's talking about preparations and additional advisors to continue through September. That is a really long time for this crisis to continue, and I don't think it can. My fundamental bias is that this is going to unwind at some point, and it's going to be Trump that declares it so. But then the question becomes, there are three parties in this war, not just Trump. So even if Trump says, I'm done, is Netanyahu done? I think Israel has a far longer kind of existential vested interest in doing as much damage to the Iranian Republic as possible. And from the Iranian side, what's their incentive? Well, they're going to keep bombing and basically putting that thumb on this very sensitive pressure point in the global economy. They're going to do that for as long as they are getting bombed, and then potentially even longer, because what they're going to do is, even if we don't have a nuke, we can take down the global economy through the Strait of Hormuz. And they want to remind people of that and reestablish that deterrence. And I think that's the worry, is that I think that the most movable kind of discretionary actor in this is Trump, because he can decide at any time to stop, and prices will probably drive him to do so. But then if he stops, can he convince Israel to stop? And if he can convince Israel to stop, when can he convince Iran to actually open the strait? And what would he have to give them to induce that behavior? And no one knows the answer to that.
That's a very good point. What's the bargaining chip here, right? There's always quid pro quo. So the all-time high for WTI was $147 in 2008. And when adjusted for inflation, that's $228 in today's dollars. But do you see the price of oil going there?
I do.
Sometime this year?
I do. Here's the thing. I think we're going to get there pretty quickly if this remains. If we're closed for another 2, 3, 4 weeks, I think we could be there by the end of April. That's just how large. And again, once that air pocket hits Asian markets and those inventories start drawing at that kind of rate, the market's going to have to bid this up. It's going to have to destroy demand. Otherwise, those inventories are just going to it's like a literal, you've pulled the plug out of the tub. You are getting some offsets. There is some flow coming out of the East-West pipeline in Saudi Arabia. We've seen, at least thus far, normal flows out of the port, the industrial port of Yanbu, which is the Saudi port in the Red Sea. That was normally at let's say 2 million barrels a day of flow. That's looking more like 4 million barrels a day now. It could get up to 5. So that's some offset. But let's say that reduces the hit from 20 million barrels to, again, optimistically 15. that is still something that is a hole too large in the global oil market to actually close through any normal mechanisms, which is where we're going to end up in this point where if prices right now if prices are unwilling, if futures prices are unwilling to bring us to the level that will either incentivize some supply out of somewhere. Again, US supply is going to have to grow here, but it's going to take 4 to 6 months to do so. And we need the price signals now to induce and incentivize that behavior for the future. And so far, we just aren't seeing those prices in any real way. So the longer this goes on, the more that incongruence between kind of this hope and this kind of, again, if I was a betting person, I think this is going to end at some point very soon because the president has to end it, but we're not there yet.
So we've seen 2 major price shocks this year, first in Venezuela and now the closure of the Strait. What does China do? Because a lot of the oil coming out of Iran and also Venezuela was going to China. What do they do now?
Yeah, so I think there's 2 different elements here. I think there's the question of the sanctioned oil that was going to China. So this is Russia, Iran, and Venezuela. And then there's the question of the kind of broader loss of the Strait of Hormuz and Arab oil flow. Let's start with the sanction side, because I think one talking point I've been trying to push back on when I've seen the kind of, there's always this tendency, because Trump does so many historic, arguably crazy things, that there's always this attempt to kind of ascribe some kind of other grand strategy. Surely he's doing this because surely he can't not have had a plan going into an Iran war. Surely, this is how conspiracy theories are born, right? Because it's easier to accept kind of a malevolent plan than the lack of a plan at all. And I think that's what some people have a tendency to do with this China and this sanctioned oil stuff. But the thing I want to remind people is that, because yes, China was largely the sole importer of Iranian crude and Venezuelan crude, and the largest single off-taker of total Russian crude as well. Very clearly, Russia or China did not care about violating U.S. sanctions, and that's probably a problem for Washington. But when Trump is saying this is all about kind of removing China's cheap oil supply, the important thing to remember is that the oil supply was only cheap for China because of Trump in the first place. He imposed those sanctions on Iran and Venezuela and Russia that basically forced China into that final kind of consumer of last resort for their barrels and got rid of all their competition. So if Trump didn't reimpose sanctions on Iran and scuttle the JCPOA in 2019, if Trump didn't impose heavy sanctions and kind of sanction designations on PDVSA, Venezuela's national oil producer, in 2019, those barrels would have kept going to U.S. ports, to other ports. And again, I'm not saying that sanctions are wrong, because they are a tool of statecraft, and I think in isolation they can be very useful in various things. But then you can't say we're taking away China's cheap oil. It's like, you gave them the oil in the first place that was cheap. So it's kind of this sure, yes, but there was a reason that it was there in the first place. But I will say, to this question of, and then China's always able to get alternative supplies if they're available. It was happy to pay really, really cheap prices if it could get away with it. But now we go to this kind of closure of the Strait of Hormuz and the overall loss of flow to the Middle East. That's an existential crisis for China, because the barrels that China would have bought to offset Venezuela loss or Iran loss or whatever, that would have come from the Middle East. And those are the barrels that are actually currently trapped. One final point here that I'm going to say is that the irony of this kind of point around, again, people have said this is about Trump clamping down on Iran's oil trade, or Trump's going to take, Iran's oil like they took Venezuela's oil. The only major exporter in the region that continues to flow barrels out of the Strait of Hormuz is Iran itself. In certain weeks, you've actually seen increases in the flow of Iranian oil out of Kharg Island in plain view of everyone in the region, but they're some of the only barrels that are getting out. So again, there's this incongruence, this inconsistency between all the talking points coming out of Washington and what's actually physically happening on the ground.
And remind me again, Iran produces, is it 4 to 5 million barrels a day?
So that's its maximum kind of historic capacity. Right now, it's producing more like 2 something. And it exports between 1.5 and 2 million barrels a day, typically.
And if the U.S. is allowing Iran to move oil out of the Strait, why would they allow that?
It's a great question, because it doesn't seem to make a lot of sense. There's a couple of reasons. One, Trump is acutely concerned with the price of oil, and any loss of further contributing to tighter oil flows out of the Hormuz kind of goes against that. So Yes, it's still feeding the Iranian regime with funds to continue the war, but it is, at least on the margin, keeping markets slightly looser than they would otherwise be. The other thing is, yesterday the IRGC put out a note a proclamation, let's say, and we're all just doing proclamations these days. So they put out a proclamation saying if Trump or Israel or whomever was to take out or otherwise kind of capture Karg Island, and Karg Island, for those that aren't aware, is the island that serves as the primary staging point for the vast, 85-90% of Iranian exports comes through this one island called Karg Island. And that island was occupied many, many times, by the way, during the tanker wars. But so in this episode, the IRGC said if U.S., Israel, whomever takes out or occupies the island, then Iran is going to start targeting other port infrastructure in the region. So I was saying earlier, so far they haven't been targeting, at least to the degree they could, some of the kind of more durable kind of facilities in the region. If Iran does that, that's when this goes from my current framework for this is that we grind kind of $2 to $3 a barrel higher every day. Every day this goes on, we're going to get choppy, but structurally, we get $2 to $3 a barrel tighter every day. That's going to go through step changes. If we get a big attack on a facility, on a major port, on a major oil field, that can go, that goes jump in $10 in a day. And then we continue that $2 to $3 a barrel grind higher from those levels. So that, I think, is the remaining kind of point of concern. And I think why Trump hasn't attempted to go after those Iranian exports, at least yet.
President Trump and President Xi meet on March 31st in Beijing for a 3-day summit. Do you think the actions in Venezuela and also Iran are strategic moves ahead of this meeting? Do you think the U.S. is trying to show China that, hey, we're in control here? Maybe.
But I think in some ways, Beijing has been preparing for this as well. One of the big storylines over the past couple of years has been how voraciously Beijing has been building up its own strategic stocks. So while the U.S. stocks have been generally declining, and both because of the Biden releases, but even before that, you had congressionally mandated sell-offs of the SPR to basically paper over budget deficits in various points. So that was going to decline with or without Biden. And basically, we're back to roughly where we would be today, even if we didn't have the 2022 price shock, because again, those mandated sales. During that period, China was going the exact opposite direction. In the latter half of last year, you had more than 1 million barrels a day in the first half of last year, more than 1 million barrels a day going into Chinese strategic stocks. Now, obviously, is the moment where those are going to get tapped. Now, that is going to help the Chinese market, but we're already seeing a way in which Beijing has basically blocked off any of the way that could help the global market, because like in 2022, Beijing and Chinese independent refineries, the so-called teapots, were largely a major source of relief, particularly in that middle distillate, that diesel market spike in 2022. They ramped up aggressively their exports in the winter of that year and helped kind of ease that crisis. Already, Beijing has banned the export of refined products in this crisis. So even if they did release SPR stocks, it would be for domestic markets, and you wouldn't see the same relief externally, which is going to be a problem given that we're staring down a very similar crisis in middle distillates.
Do we have any idea how large their SPR is?
It's over 1 billion barrels. We don't know exactly. And I think, again, the exact definition of Chinese strategic stocks is also a little wonky, because some of them are explicit state-owned stocks, and some of them are commercial stocks held by state-owned or mandated stocks that are held by state-owned enterprises. So it's kind of like a quasi-strategic stock. They had last year they had a policy change that required what they called commercial strategic stocks. So again, I would say overall, I basically treat any crude stock in China that doesn't behave like the rest of global stocks. It's kind of more it's not so much what it is and who owns it as to the character of how that flow behaves. When you look at coastal stocks by like the major refineries that we can see, they basically look exactly like US stocks. They're low right now, they kind of rise and fall with everything else. But inland stocks, very, very high, over 1 billion barrels.
And so China has 1 billion barrels. How does that compare to the US?
US is about 400 something right now. Across the entire OECD and the IEA members, we're looking at roughly 1.2 billion barrels of state-owned, mandated, held crude and product stocks. That'll help. But we're talking basically China has basically the same amount as and that's just crude on China's side. We actually don't know their product stocks very well because they don't publish data on them, and you can't see the tanks in the same way you can see crude because they don't have the floating tanks. So we're a little bit blinder on the product stocks, but they have as much crude stocks as almost the entire IEA member states have entirely across crude and products.
Russia is I believe the second or third largest producer of oil in the world, producing somewhere between 9 to 10 million barrels a day. Are they the big winner in all of this?
They are absolutely the big winner. I've been really stressing this point that Moscow has far and away taken more and gotten more benefited out of this war than any other single participant or other single producer. And the reason is, to the White House's credit, I think I've been pretty critical of the White House and the Trump administration thus far. To their credit, they were doing a very, very good job at tightening the noose around the Russian oil trade over the past year. They had again, I had mentioned like India is the largest importer of seaborne crude out of Russia. They used to import nothing. War in Ukraine, all of a sudden the price cap and the EU ban on imports, and India emerged as this major buyer of discounted Russian crude. As of mid last year, they were importing more than 2 million barrels a day of Russian crude. Again, largest seaborne importer. In October of last year, the Trump administration imposed blocking sanctions on Rosneft and Lukoil, which are the two largest exporters of Russian crude. So that took a big chunk out. And then the Trump administration imposed punitive tariffs on India due to the import of this Russian oil, and basically said, get off the oil or you're going to have this 25% U.S. tariff on you. That combined action reduced Indian imports of Russian crude from around 2 million barrels a day, say beginning of October, to around 1 million barrels a day in January. That's a huge change. And you saw discounts borne by Russian crude explode, upwards of $30+ a barrel under Brent. And you saw Russian crude on water rise really quickly because those barrels had nowhere to go and they were kind of lingering around waiting for a discounted sanctioned buyer. Now, after this war started, every single Asian buyer is clamoring for those Russian barrels. You've even had Eastern European countries trying to pressure the EU to reduce sanctions on Russia to allow them to import oil and products through the Druzhba pipeline, which is the major pipeline that connects Russia to the European market, particularly through Eastern Europe. And you've even seen the White House and the Treasury issue an explicit sanctions waiver for India to import what was previously banned and sanctioned Russian imports. So Russia is far and away the biggest beneficiary of this, and any of the pain that we saw imposed on them over the last year has basically already been unwound in the past 2 weeks.
Rory, everything I do on this channel is focused on investing, and I guess I want to look at it from my point of view. I'm always thinking about how can I make money or how can I minimize my losses. And if I hear you right, the message you're telling me is you got to get long energy. You got to be long oil. You got to be long nat gas. Is that correct?
Yeah, I think so. I tend to, on my side, I tend to try and stick to the commodity market, not go too much into the equity side or anything else. But I think what we have seen is that so far equities have generally under-responded to this on the producer side. You've seen some uplift, but in some Canadian names have actually been kind of down through parts of the crisis. I think that's obviously one way to play this. But I do think that there is also a risk here. I think, it's exceptionally, I think I've never been more bullish in my entire career on the immediate spot market impacts. There are bigger questions down the line. Again, if this keeps going, recessionary would be optimistic. We're talking depressionary conditions. Energy stocks don't do well during those crises, right? So I think that's a risk on the downside you need to watch for. Also, again, back in I mentioned 1970s, you saw demand destruction during that period that we had never seen in history before. This is, again, I think all else equal, before and after this crisis, Asian markets in particular are going to be consuming less oil in 10 years than they would have going into this crisis. Now you're going to have major, even both consumer backlash, but also government strategic backlash to this level of dependence. And they're like, well, we always knew this was a risk, but we never, like myself, I never thought it would actually happen. Now that it has, they're going to begin trying to insure against that risk in the future, which is largely about diversifying away from that dependence and the demand on fossil fuels and oil in particular. So I think there's a mixed element here, but I would say in the immediate term, if you can get exposure to higher crude prices over the next 6 months, I still don't think the current market price and the current curve is incorporating even the damage that has already been done to the system, let alone the risk that we face to the upside. So I see the risks to oil prices definitively tilted to the upside over the next month at least.
Yeah, it's going to be interesting to see these economic numbers that come out here in the next few months, because inflation has been very resilient. Even before oil ripped to, call it 90 or $100 a barrel, it was hanging around 3%, and it's definitely going to have a big impact, especially when the consumer starts bearing more of the brunt of these higher prices.
That's exactly right. And I think, I think like to your point, you mentioned kind of, inflation and central banking. If there was a hope that central banks were going to be cutting, I think that's off the table now, at least for a while. So if you're in the position of having to remortgage your home, that's going to be an issue for you. And I think that's best case scenario of not of slowing the pace of cuts. And I think we could be in a situation, if this continues, that we're going to have to go back to a point of hiking in order to kind of try and contain some of that pricing pressure. And again, back to that unmooring of inflation expectations at the consumer level. That's obviously a major problem. And I think, again, supply shocks are a central banker's worst sniper. And this is like the mother of all supply shocks, because it particularly if you're a dual mandate central bank like the Fed, it's going to push both of your indicators, both of your targets in very different directions. So then you have to choose which one do you prioritize. And unfortunately, as we learned even in 2022, there's no easy answer because there's no stipulated legislated priority of those targets. It's both of them are important. So then how do you kind of balance that? And at the time, the Fed chose prices. And I think that was probably the right call. But if this is longer lasting, and let's say in 2022, we didn't get the rollover over COVID zero in China or wherever else, there's no telling of how that would have gone if that kind of policy structure would have continued.
I want to ask you one more question before we wrap it up. The U.S. is the world's largest oil producer. They produce 13 to 14 million barrels a day. 60% of that comes from shale. When does shale production start dropping off?
So actually, I think so. Prior to this, one of the really interesting trends was that we actually, in both my forecasts and a kind of official forecast from the Energy Information Administration, the kind of statistical arm of the Department of Energy in the United States, everyone started seeing that U.S. shale was plateauing this year, that we basically had that it was going to flatline this year and begin to decline outright next year. That is likely on hold now because these prices are going to provide a major lifeline to those producers to begin lifting. So the Dallas Federal Reserve typically puts your kind of like average incremental point of kind of your incentive price for new production, call it low to mid 60s on a WTI basis. We're well above that now, and you can hedge for the next 6 months well above that. So I think at that level, you're going to begin to see growth again. The issue is that it's going to take 4 to 6 months for that price signal to turn into realized production gain. And again, if we're 6 months into this, we're in a very, very different global market, and that's going to be deeply, deeply kind of volatile. And then the other thing you're going to see is that you are also seeing, because again, Trump has heard the U.S. is the largest oil exporter, and that's just crude oil. You cited the 13, 14 million. You actually have 6, 7, 8 million barrels a day of natural gas liquids like propane and everything else and refined products. Overall, the U.S. is actually pretty, on an apples-to-apples basis, pretty secure on that basis. The problem is regionally, you have all of these dislocations. More exports to the U.S. Gulf Coast, imports into the East and West Coast. The Gulf Coast can't service those imports because of the Jones Act. So you have all this necessary trading. And one of the things that Trump has been reportedly musing, and the Biden administration used in late 2022, was a ban on the export of refined products in the United States. If that happened, we end up in a deeply kind of confusing and dislocated market. I mentioned earlier that even in this worst scenario, we all pay awfully high prices, but things continue more or less as they are. If you begin banning exports or go full Nixon and cap prices at the pump, that's how you get shortages in advanced markets. That would be a policy choice. We would be able to bear that economic cost, but I think it begins like, shortages are harder to show in a chart on Fox News Business. And I do worry that there's a little bit of a prioritization of what can be shown easily in kind of a media hit.
Well, Rory, this has been a great discussion. I want to thank you very much for spending time with us today. We got to do it again in a few months, okay?
I'll come into the studio then.
So now if somebody wants to follow you online and check out some of your research, where can they go?
Yeah, so you can follow all of my work at commoditycontext.com, which is where I publish, typically 2 reports a week. Obviously, right now is a bit crazier. And then additionally to that, you have all of my work. I kind of tweet in real time on Twitter or X now at Rory_Johnston. And I encourage you to follow along and kind of join me on this deep, deep, chaotic journey that I never thought I'd be on.
And you also have a podcast?
I do have a podcast as well. It's called the Oil Ground Up Podcast. It's through the Clear Commodity Resource Network, so you can follow them as well, and the Oil Ground Up Podcast. And yeah, follow us and follow along. Well, I should have I'm filming a podcast for my own podcast immediately after this, James. So it's back to back to back on our end.
Once again, thank you.
Thanks for having me, James.